Hi, I'm John Vance, President and Founder of Vance Wealth. Thank you for joining us today. Our topic is our mid-year economic and market update, and we're going to cover the current markets and where things are headed. When we go through topics like this, they tend to be pretty data heavy, so I'm going to do my best to explain the concepts as we go through them. So when I pull up, there's a lot of data when we go through market updates, and just wanted to give you an idea of where things are. So the first red circles that I have circled here are the S&P 500. So the S&P 500 year-to-date return, which is YTD, is up a little bit over 18%, and this is through the middle part of the years. And then the three-year cumulative return, which means how the market has done over the last 3 years, is up 34%. So obviously this has been a good 3-year time frame, a good year-to-date, even with volatility in the markets that we've seen over the last 3 years. And so one of the things that I do find interesting is I was reviewing my notes from last year, and the reality is, many people were calling for a recession. Many people thought that markets were not going to do well, and now we take a look at where we are today, and the markets have been quite strong, and to a surprise of many. But that's also why we're long-term investors, and a lot of this short-term stuff is day-to-day noise that we try to avoid and really focus on the long-term. And then if we look here at the bottom, this is fixed income. So fixed income, otherwise known as bonds in the portfolio. Returns aren't great in this space. They are slightly positive. So you can see the U.S. aggregate index, which is just looking at the entire bond market, is up not quite 1%. And then corporate bonds are up a little bit over 1%. The real pain point here is this 3-year cumulative return. So we're still coming off a really tough 3-year environment where bonds are still negative. So when you look at their yield, meaning the income that's generated, plus or minus their gain or loss, which means a loss, they're still in a loss position. So they're down over 7% cumulatively over the last 3 years. And that's really just a byproduct of raising interest rates. So when the Fed embarked on raising rates to try to curb inflation, we saw that bonds did not perform well. The good news is, if you look here on the left-hand side next to where it says fixed income, there's this yield. The current yield on bonds is quite attractive, between 4.75 and higher, and that is a very good predictor of future returns. So we're excited about the prospects on a go-forward basis, but it's still been a pretty tough environment, and this year has been mediocre. When we break down what's been going on in the U.S. markets, we have a few things. On the left-hand side, this is just designed to show you how the industries of the S&P 500 are doing. So how are the different markets? All of them are positive. You can see we were being led by technology stocks, which is not a surprise given all the things that are happening in artificial intelligence and just that space and how attractive that's been for a lot of these big tech companies. And then you can see the bottom side of that is real estate, slightly in the positive. However, we know real estate's been a challenged asset here as of late because interest rates have risen to the current levels. And then if you focus on the chart on the bottom right, sometimes I take for granted that everybody understands what this chart is. This is known as a Morningstar style box. And what this is designed to show us is that inside of the current U.S. market, there are many different types of companies and industries and basically style boxes and returns can vary quite differently. So the top right represents large growth companies, so large multinational growth companies, and these are the familiar names like the Google, the Nvidia, the Tesla, names like that. And then the bottom left corner is small value, and these are a bunch of names you wouldn't even recognize. And so when we look at the deviation of returns, large growth is up to over 24%. Small value is only up 4%. So we're definitely seeing a continued outperformance in the large growth space. This has been a theme that we've talked about for the last several years, and actually, frankly, the last decade. And that trend has continued this year. And we're going to share some of the longer-term data once we get into the S&P presentation part of this. So just want to give you an update on this. At the end of the day, the way we build portfolios is we are going to use a majority of these different industries, and we're also going to part of the allocation strategy is to fill up the style box, which means we're going to own parts of your portfolio are going to own all of these areas, because that's how we accomplish broad diversification and help to manage risk and portfolio returns on a go-forward basis. All right, now we're going to get into some stuff. It might be a little rapid fire, so Hopefully, depending on the screen that you're on, you can read some of these slides, and I'm going to do my best to describe as we're going through this. But one of the things that we recognize is this is the fourth best start to a year in technology stocks. So pretty crazy when we're looking at how strong these returns have been in the last 35 years. And what this has generally meant in the past is that when we had a good first half of the year, the second half of the year was also strong. So this does bode well for a strong second half. Some of the challenges that we know are going to be on the horizon going into an election year, or in an election year going into election season, that's probably going to promote some more volatility. But just wanted to share, on the left-hand side, it shows tech stocks are up over 28% and the S&P is up 15%. And those are a little bit higher than the data I showed you on the prior chart, just because these are as of June 30th, where the other ones are, the other data is updated as of July 14th. Large cap stock outperformance, basically the largest since 1999 over small cap stocks. So on the left-hand side, you can see the yellow chart shows what large cap has done relative to small, and cap means company, so large company. And so if you look here, this has been a 3-year period where large cap has continued to outperform small. If you look on the right-hand side, this just basically gives you some historical data that we will refer to a little bit later that just shows 3-year periods of outperformance. And so we haven't seen this big of an outperformance. You can see over here, June 2024, we're seeing that the pretty substantial outperformance relative to small. We haven't seen this level of outperformance going back to April 99. So that was kind of towards the tail end of the dot-com bubble, which subsequently ended in March of 2000. And so we've seen periods of time where large cap has outperformed. We're living in one of those now. You can see this chart here. We've definitely gone through a period. We do think that trend is going to change and going to shift, because markets just tend not to go in the same direction, but it's definitely been a trend that's been in place for about 15 years. And I'm going to show you some of that data as well. Lots of data here, but one of the crazy things is we recognize basically the top 10. If you look at the S&P 500, that measures 500 companies, 500 U.S. companies, and basically the top 10 of those companies has really driven a lot of the performance. So you can see on the left-hand side, it shows valuations, higher PE ratios, way higher than the average. And then on the right-hand side, it shows you there's two boxes, the weight of these top 10 stocks in the marketplace. And so this is essentially one of the largest overweights we've seen on the top within the top 10 stocks on the S&P 500. And so you can see the chart shows that 38% of the market cap of the S&P 500 is made up of the top 10. When we're back in 2000, kind of at the end of the last tech boom that we saw, that number peaked out at just shy of 28%. So we've definitely extended to the upside. And that's just been driven by, we have great US multinational companies that are really thriving in this environment. The interesting thing though is if you look here, earnings contribution of the top 10, so they're driving about 24% of the earnings contribution, even though they're valued at 38%. So this does suggest to us that there's probably, this part of the market's probably a little bit, has maybe got ahead of itself a little bit. And we are favoring more of a broad-based approach. Because the reality is, one of the things that we look at is that if they're driving 25% of their earnings and they make up 38% of the value, that would suggest that they are slightly overvalued at this time. Doesn't mean that they can't continue to be this way, but that's just the reality of what we're seeing in the marketplace. Now the top 10 stocks, it also includes what's called the Magnificent Seven, and this is really the companies in the top 10 that are focused on technology, and you can see the performance numbers that we're looking at. And this box I know is a little bit hard to see, but basically the Magnificent Seven year-to-date returns is up 41%, which is driving like 2/3 of the return. And then if you take those companies out, what's the rest? What are the rest of the companies doing? Meaning the other 493 companies in the S&P, they're only responsible for about 5% of the returns. So kind of crazy to see that we are still having this concentration of these big companies. And again, that'll go through ebb and flows over time. We want to continue to monitor that. But that's a big part of portfolio diversification as well as rebalancing, is to make sure that portfolios aren't getting overexposed. But they're definitely seeing some really nice, healthy runs. And again, these are all the big names that we all are very familiar with. As we start shifting away from some of the things that are happening in the markets, we have the Federal Reserve has definitely been in the headlines all year long, and frankly for the last many years, and they're really trying to bring inflation down. Inflation has come down The inflation data that we're seeing on this chart represented in this red color. On the far right hand side, it does show that inflation has declined. We're starting to get closer to the Fed funds, or excuse me, the Federal Reserve target of inflation, trying to get the inflation target down to roughly 2%. And so as of last print in May, we were at 2.6. In June, it ran even lower. So we're on the right track, which now is why you're hearing a lot more, reading a lot more headlines around the Federal Reserve being willing to cut rates, maybe 1 or 2 times here as we wrap up the year. But what this chart is designed to show you is that we tend to be in an environment where when inflation is low, the federal funds rate is low. So what this is suggesting is that right now with the Fed funds rate at 5.3 and the inflation rate at 2.6, that there's a disconnect, right? So what this means to us is that the Fed does need to cut rates, because if they continue in a higher rate environment, that could lead us into a recession. And I know that's one of the things that we're really trying to guard against, is to make sure we don't slip into a recession. And so that's why the Fed is starting to talk more about this. And if you look at previous periods of time, when you've seen the Fed funds rate, which is this yellow chart, I don't know if you can see it, where it's above inflation, it's kind of these peaks of where in periods of time where we had recessionary. So the gray bar charts that run down the middle represent recessionary periods. And in all these periods, when we look back since 1990, high Fed funds rate relative to inflation, I don't know if it pushed us into those recessions, but it definitely, you can see we don't know if necessarily it's a correlation or causation around the fact that the higher Fed funds rate relative to inflation is generally not a great thing for our economy. So with all that being said, we think that we are going to start seeing rates come back down, which is also really important to us, because we think that'll bode well for growth stocks. It'll bode well for real estate. It'll also mean that a lot of our cash, meaning money market and T-bills, the rates will start coming down. So there is definitely going to need to be some rebalancing and making sure that we reset expectation for what things look like on a go-forward basis. Really noisy chart, but it's actually quite simple. Basically, this shows contributors to basically headline inflation. So what is causing the inflation? And you can see when we peak back here in July of 22 at like 9%, you can see this green is energy, orange is core goods, the purple is food at home, blue is dining, recreation, other services, red is auto insurance, and then you have blue is shelter. So the reality is, as we've seen rates come back down, you can see things like energy prices have subsided, which is why green is down here below 0. And so we've definitely brought the inflationary numbers back into track, or back in line. So I just wanted to show this to you just so you can get an idea of how these inflationary numbers were being tracked. We are on the downside of this, and so we do think. I mean, we had been calling that for inflation to come down. Even as it started to rise up, I think this did surprise us a little bit. Some of these peak levels of inflation. The reality is there was so much money in the system that created some of this inflation. So we're working through this, which is healthy for the economy. Some industries are definitely struggling. Some individuals are struggling through this environment, but we are headed in the right direction on inflation, which will allow the Federal Reserve hopefully to cut rates and to ease the cost of borrowing.